So we have an illustration here, and that is, I just want you to pause the video for a while and try to solve it by yourself, and then we can solve it together. Okay, so let's solve it together. Eastern Corporation, the investment banking company, often has extra cash to invest. Suppose Eastern buys 1,000 shares of Dream Incorporation at 57. Assume Eastern expect to hold for a month and then sell it. The purchase occur on December 15. On December 31st, the market price of the share was 58. What type of investment is this to Eastern? Give the reason your answer. So I have pasted the answer. This is trading. Why? Because it is intended to a very short time, or within the short time, right? It's just for here for 1 month, right? So okay, so record Eastern purchase of the Dream stock on December 15. So when it purchased 1,000 stocks at 57 each. When it purchased, what is the answer? You pay cash, so cash is credit, right? When cash is credit, then the debit would be increase in asset, which is trading security. Here, trading security to cash, right? And adjustment on 31st, it increased its value from 57 to 58. So there is 1,000. It's realized or unrealized, because the question didn't say that you actually sell it. It's still in your hand, so it's unrealized gain. So unrealized gain is there. It means you have to increase the value of trading security. So entry would be trading security to unrealized gain. Answer would be with 1,000 and 1,000, right? Okay, so how it will be affected on the balance sheet. So investment in securities, if you make the T account, so securities will be, debited by first cash and then unrealized gain. Answer would be 58. So this is the value that will go to balance sheet, and on income statement, the unrealized gain is a part of other revenue and gain, and we call this 1,000. Okay, let's make the fourth illustration, that if Eastern did not intend to treat the Dream stock as a trading security, but still intend to treat it as a short-term investment. So what we have are three categories. One is trading security, one is available for sales statement securities, third is held to maturity. So it only fits in the category of available for sale securities. We categorize our investment as available for sale securities. Then if we purchase, how we gonna record the purchase? It's simple. The available for sale securities to cash, and answer is 57,000. And what is the adjustment of when the market price increased to from 57 to 58? The same entry, except that it is for available for sale. The unrealized gain on available for sale, that will go to OCI. That is a part of OCI, not the income statement. So entry would be the same, that available for sale securities to unrealized gain on available for sale securities. This is just optional here. Number 3 is show how Eastern would report this investment on its balance sheet. It's the same. You make this account is coming from the T account. On T account is the sale, available for sale securities. First one is the purchase, 57, and then the unrealized loss gain is then 58, and then 58 come here. But the 1,000, that is unrealized gain, it's not a part of income statement. So here we do not write down the income statement. We write down it is a part of shareholder equity. Here it is under other comprehensive income, and it will be it will be, you know, represented in this other comprehensive income statement, which is not the, required financial statement, because this is a part of shareholder equity or retained earning, part of shareholder equity or retained earning statements. Okay, let's move further. Okay, now let's talk about our learning objective 2, which is apply GAAP for proper revenue recognition. So we already discussed in our, I think, chapter 3. We already discussed this one, expense recognition and revenue recognition. Just again to clarify. So revenue recognition is when the performance obligation is satisfied, between when you send the goods to the customers. As soon as you send the good to the customer, you can record the revenue on the basis of determinable fixed price. It's not like that you send the good and in transit, if the price rises, you say, okay, I sell at a higher price. No. And then there is a reasonable collection assured, plus revenue is cash value of the goods and services, and impacted by shipping terms and payment incentives offered. What does it mean? It means if you charge the price on the basis of freight as well, or the postage service as well, then you include that postage service as well. Okay. And then we have an example here. For example, Apple Incorporation delivers truckload of iPhones to an AT&T wireless warehouse in Florida. On truck, 30,000 iPhones, each of which Apple sells for $100 on account, right? So since the Apple sells it on account, right, which means on credit, so how are we gonna record this one? Sales occur, yes, right? And what is the entry? Entry would be the account receivables to sales. Why? Because we are selling on account, so our AT&T will be our customer, and we call this account receivable, right? Account receivables to sales revenue, or just revenue, or just sales. You can just write one of the, for two it's okay. And then we know that the sales are affected by the shipping terms, revenue is affected by shipping terms. So what do we mean by the shipping terms? FOB. So FOB, free on board shipping point, and FOB destination point. What does it mean? So FOB shipping point is that at the point where the goods leave the seller's ship dock. That's it. If you import the goods from China, so seller's responsibility is that he put the sales to the Shanghai port. That's it. Now it's customer responsibility to pick the goods from there. Or if you are also in Shanghai and the seller is also in Shanghai, FOB shipping point is that at the point when the goods leave the seller's store or seller's shop, sales occur. The next one is FOB destination point, in which you give, like you are buying from online Taobao, when you receive the goods, then sale occurred, right? At the point of delivery to customers.